Patiently waiting. You have been connected for the V-Guard Industries Limited earnings call. The call will begin shortly. Please stay connected. Thank you. This is the conference operator. You've been connected for the V-Guard Industries earnings conference call. The call will begin shortly. Please stay connected. Ladies and gentlemen, good day and welcome to the V-Guard Industries Limited Q4FY2022 earnings conference call hosted by HDFC Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Naveen Trivedi from HDFC Securities. Thank you, and over to you, sir.
Yeah, good afternoon, everyone. On behalf of HDFC Securities, I would like to welcome the management of V-Guard Industries to discuss the post Q4 F22 result. We have with us today the senior management of V-Guard Industries, represented by Mr. Mithun Chitrapalli, Managing Director, Mr. Ramachandran, Director and Chief Operating Officer, and Mr. Sudarshan Kasturi, Senior VP and CFO. I would now hand over the call to Mr. Mithun for his initial comments. Thank you, and over to you, sir.
Thank you, Naveen and HDFC for hosting this call. Very warm welcome to everyone present, and thank you very much for joining us today to discuss the operating and financial performance of our company for the fourth quarter and the financial year ended 31st March 2022. We are pleased to report a strong performance in the fourth quarter, with revenues crossing the milestone of 1,000 crores for the first time, delivering a growth of 23.7% YOY, despite some challenges related to the third wave in the first few weeks of the quarter. We were able to end the fiscal year on a very strong note. Electrical and consumer durable segment achieved strong growth, while electronics showed a moderate growth. In Q4, we witnessed broad-based contribution from both South and Non-South markets that witnessed YOY growth of 25.4% and 21.5% respectively. We continue to grow well in the Non-South markets, which is enabling the emergence of V-Guard as a strong nationwide brand characterized by a more diversified revenue profile. On the product side, in the electric segment, comprising of wires, pumps, switchgears and modular switches, we registered a growth of 32.6% YOY. In the consumer durable segment, where we market fans, water heaters, kitchen appliances and air coolers, Q4 revenues grew by 32.3% YOY. Our electronic segment, comprising of stabilizers and inverters, there was moderate growth as the demand for summer products had a slow start to the quarter. Margin pressures due to commodity price inflation continue in select categories. In a competitive market, we have taken large price hikes over the last few quarters. We are actively working on addressing the remaining pricing gaps. In addition, we have instituted cost optimization measures across our operations to support and restore our margins. EBITDA margins were at 10.6% in Q4 FY22 compared to 12.9% in Q4 FY21. Going forward, we expect margins to be driven by volume growth, pricing actions, and better fixed cost absorption, while advertising and promotion spends increase further to normalized levels. We have made the choice to migrate to new tax regime enabling us to benefit from the lower rates. This is effective retrospectively from FY21. There is a write back of tax in the current quarter. As a result, profit after tax improved to 90.6 crore in Q4, including 13 crore as tax write backs. In February 2022, we invested a further 15 crore in VCPL or V-Guard Consumer Products Limited, our wholly owned manufacturing subsidiary. This is towards setting up manufacturing projects through VCPL. The first of which has already commenced operations in Uttarakhand. These new facilities will enable us to be more self-reliant in our operations and also derive long-term cost competitiveness. During the year, we have taken a conscious call to increase our inventory norms with the risk of supply chain disruption diminishing. We are now moving towards normalizing inventory levels. There has been some improvement in our working capital position as compared to the end of the previous quarter. We believe we are well placed to meet consumer demand over the coming months, and this will enable us to get back to normal inventory levels, resulting in stronger cash flows from the business in the coming quarters. As we enter a new fiscal year, V-Guard is well positioned to benefit from the resilient consumer demand, given a wider product portfolio, expanded national presence, and investments in capacity and augmentation. With that, I conclude my opening comments. I would like to thank once again for your participation and would like to hand over the floor to the moderator for Q&A. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rahul Agarwal from InCred Capital. Please go ahead.
Yeah, hi, good afternoon and thank you for the opportunity. Sir, first question essentially was on the demand for stabilizer and inverters. You mentioned on the commentary that electronic growth has been slower. Could you help us understand what is really happening with that right now?
So currently, we had a slow start for the quarter for that category. Even the current year is fully, the category was under, tremendous pressure in terms of demand. That is both stabilizer and inverter. Because even in Q1, we had those lockdowns and, we couldn't sell anything. And they're extremely, seasonal products. But what we've seen in April onwards, there has been strong demand. So you would have, heard about strong demand for air conditioning. There was also power cuts. So there was strong demand for inverters. So I think this year we should have a much better, number from the electronics division.
Right. So April, May has been much better than what we saw in fourth quarter. Is that understanding correct?
Yes. Although we are currently not talking about April, May, but I can say generally the demand has been strong in April. May has been slightly weak in south and east, but north and west continues to remain strong.
Got it, Nitin. And the second question was for VCPL. So could you help me with total investment till date in the subsidiary and what has the factory started to manufacture now and what should we expect over the next 12 months in terms of in-house manufacturing?
So far, investment in VCPL is about 60 crores. This is towards the first plant. That is the plant which manufactures stabilizers and inverters. That plant has just about started operations.
So what we have started to manufacture is effectively stabilizers, and I think by August or September we should start, the full range of products.
When you say full range, it's basically talking about wires and fans also here?
No. I meant for the plant is to manufacture only stabilizers and inverters.
Okay, got it. And lastly, why has the employee cost come off quarter on quarter? That's my last question. Thank you.
Why the employee cost reduced? Come off.
Yes, the employee cost has actually gone down quarter on quarter. What is the reason for that?
Gone down because there are some write-backs on incentives and variable pay. So that's one reason. Also, the comparator Q3 there was a one-off cost. So both these put together.
Could you quantify that, please? Like third quarter one-off and fourth quarter, what is the write-back?
There was a 4 crore one-off in Q3 and there is a write-back of about 5 5.5 crores this quarter.
Okay, thank you, sir. I'll come back in the queue. All the best.
Thank you. Next question is from the line of Sonali Salgaonkar from Jefferies India. Please go ahead.
So thank you for the opportunity. So my first question is regarding the price hikes. Could you help us quantify your cumulative price hikes on an average in F22, that's full fiscal, as well as any incremental price hikes which you have taken from 1st of April or hope to take in the coming quarter?
Okay, so the FY22 cumulatively price hikes have been about 10%. That is excluding wires. 10% blended.
Wire will be something like...
wire will be like 35-40%.
Wire will be about 30-35%. And the X-wire will be about 10% for FY22.
And any price hikes which you have taken in Q1 or hope to take?
Price hikes in water heaters and fans, some pricing action has been taken in April.
Yeah, we have taken some price hikes for water heaters and fans. I don't have the exact number with me, because they will be landing in phases. We will send the price list and it will be affected in phases, depending upon geography and market.
Understand. So my second question is regarding the current demand levels and inventory. So are you seeing the demand has peaked off, in May, by mid-May, or do you foresee strong demand to continue till the first week of June? And what are the current inventory levels in the channel?
So the inventory levels in the channel is fairly healthy. I think we are having, almost, we are doing secondary tracking. So we have data of the, secondary inventory. Almost 75% of the channel partners, we have, real-time visibility. So the inventory levels in the channels are not very high. And we ourselves have decided, starting in January itself, that we will tone down our inventory levels because we have not faced that much of, supply chain shocks as we expected, except for a few items like electronics, where we'll continue to hold inventory. So our inventory days, has gone up by about 15 days on an average, and it will come down, progressively. Starting, in June, you will start to see some reduction, and in June, in September quarter also you will see some reduction. As far as demand is concerned, we are in a business where almost 50-60% of our revenues are coming from demand for products from summer category. So, you'll be reading in papers, we had very high temperatures in March and April, and May onwards, southern part of the country has received rains, eastern part of the country has received rains. So the demand is according to that. Like I mentioned, the demand continues to be strong in north and west and a little bit weak in, south and east.
Got it, sir. So currently, what proportion of our manufacturing is in-house and what is the capex guidance?
About 60% is now in-house. Your second question was?
Capex guidance.
Capex guidance. Now we will stick to what we said earlier, about 200 crores over 3 years.
200 crores in the next 3 years. Over the next 3 financial years.
Then my last question, what is the tax rate that we should expect going on from here, F23 onwards?
We can take it at 25%, 25.2. That is the ticket rate.
25.2 will be the rate, and you can take it because it will take some time for VCPL to start generating profits.
Got it. Thank you.
Thank you. Any participants who wish to ask a question at this time, they may please press star and 1. The next question is from the line of Achal Lohade from JM Financial. Please go ahead.
Good afternoon. Thank you for the opportunity and congratulations for the good performance. What I wanted to check was specifically with respect to the consumer durable business. If you could talk a little bit about what drove this growth, any particular category or region, and while you have talked about 9 to 10% kind of a price hike impact, any specific number you can provide for the consumer durables category, sir? What is the price hike impact?
Okay, so I'll just talk a little bit about consumer durable segment, and then Sudarshan can talk about the pricing part. See, the consumer durable segment has had very strong growth. We don't like to give out product-wise numbers because this is an extremely competitive industry and we don't want to, no one gives out any more, product-wise numbers. We also don't want to give out. But I can tell you that the major component is, water heaters and fans. So if you remember that, 2 years back, we had lost some share in water heaters because we were not able to supply and all that. So we have had very strong growth in water heaters. We have gained back the shares we have lost. And we are going to continue strong now onwards. Fan also, we have had some great new launches. We have mentioned that we've, started a factory in Uttarakhand about 1.5 to 2 years back. So all the products coming from our own factory are unique. They are significantly better than, what's available in the market and coming with attractive, propositions. So these have done well and they have driven growth. Plus, we had a lot of supply shocks in FY21 and in FY22, we decided that we will keep more inventory and, we have taken advantage of, the market, the demand. So that's basically what it is. The smaller part is the kitchen appliances segment. That has also grown very well. We've had some new launches like water purifiers and kitchen hoods only in the e-com channel and they have also continued to do well.
Right, and the price hike impact I wanted to also check in the consumer durable segment specifically.
That 10% applies to durables also. These price increases have been across the board, so more or less all categories.
Yeah, the cost increase in durables has been much more sharper because the durables use a lot of aluminium. They use a lot of, aluminium. They use a lot of, crude derivatives. And packaging, everything is shot up. So I think that the problem with durables has been that there has been sustained increases in, commodity. So by the time we correct commodity prices, and move on, the next round of hikes are required. So it's been a constant challenge. The good news is, barring aluminum, the rest of the commodities seems to have plateaued. So this is good news for the segment, in the coming year.
Right, and just related, I don't know if it was covered, what is the incremental price hike required to restore our gross margins?
In select categories, there are some pricing gaps still exist in select categories.
So that's if I can handle. Yeah, so I think, it can range anywhere from 2.5%, I would say 2 to 5%, depending on the category. At an aggregate level, maybe about 3-odd%, right? So,
yeah, correct. At the aggregate level, will be about 3% is the gap in gross margin.
And you mentioned something I couldn't hear, that in April you have taken certain price hike. I couldn't understand the quantum, and you said will land in phases depending on market. What was
I didn't have the number with me about the exact quantum of price hikes. I said price lists have been announced, increases have been announced. The effective landing will vary. It would have started, but it may not be. But I don't have the figure with me right.
Got it. And specifically in the electronics business segment, you mentioned that it was slow. Can you elaborate a little bit? Is it to do with, specific to South region and especially
can I just
in South?
Yeah, Ram, you can take this.
Yeah. So I think, see, as far as the electronic segment is concerned, see, fundamentally, if you look at our overall growth, right, what you would see is that the growth in non-summer categories have been stronger. The summer categories have been flat to very moderate growth, 4 to 5%, when you look at the annualized number. And even for the quarter, the growth in the summer categories have been moderate. This is basically because Jan and Feb was weak and the demand for summer categories started to pick up because with COVID coming in, the trade was not in a mood to upstock. So categories like, stabilizer, inverter, even air coolers, which is within the consumer durable category, or pumps, which is within the electrical category. Yeah. So these categories have been depressed, till the middle of March, right? Because the trade was a bit worried about the revival of COVID from Jan. However, as the summer started to pick up, the business started to pick up and we had a strong March. And that's the reason why the quarter number, was a moderate growth in the electronic category because Jan and Feb was pulling it back. Yeah? However, since then, the current quarter, the last 45-50 days, the summer has been very strong, particularly across north and west, and the electronic categories have now recovered to normal growth rates that you typically see for summer. Yeah.
Got it. So does it also mean, sorry, I'm trying to understand a bit more detail here. Is it more of a south problem than really the non-south in terms of this delayed start of summer?
No, the delayed start of summer, I mean, it was not a delayed start of summer really. It is the sentiment in the market, post, COVID.
I think, Ram, I just interject. Last 3 years, every year, we sold inventory into the trade. And in the summer, it was, either a lockdown or COVID. For example, FY21 April was a lockdown. FY21 April was a lockdown. FY22 April also, FY22 May was a lockdown. So both these years, the trade picked up inventory, but they were not able to sell out. So they were not willing to upstock this time, and they waited for the real summer to happen. So basically, the channel inventory was almost nil as we entered summer this year.
Understood. And sorry, just one more question in terms of the gross margins. Earlier we used to talk about 100 basis improvement, year on year. I know we have gone through a very volatile RM cost inflation scenario, but if we were to assume the RM prices are here to stay, how do you see the gross margins trending on next 3-4 years, given the in-house manufacturing, the premiumization, and so on and so forth?
See, we would like to increase gross margin by 1%, but like you yourself mentioned, we are in an environment where we are taking about 13 to 15% average price increase. Usually, to put it in perspective, in a normal year, even with a reasonable inflation, our average price increase will be 2.5 to 3.5%. So there's almost 4x price increases we have to take. So I think the way to look at it is like this. So when the raw material prices are plateauing, when the commodity prices are plateauing, at that time we can start to again hope to achieve this 1% improvement in EBITDA margin. Till that time, I think it may be difficult.
Got it. Thank you. I'll come back in the queue for the further questions. Thank you.
Thank you. The next question is from the line of Ankur Sharma from HDFC Standard Life Insurance. Please go ahead.
Hi, good afternoon. Thanks for your time. Couple of questions. One, on one side again, as you said,
your voice is breaking. I request you to use the handset.
I am using the handset.
Yeah.
Is this better?
Yes.
Yeah. So, thanks. Yeah. So, I was saying that, just on the demand again, and as you said, and not just for you, for the sector as a whole, we've seen price hikes in the region of 12 to 15%, which is quite abnormal, right? I mean, typically we take about 2-3% annually. So, I understand summer's been good, so cooling products would have done well and continue to do well. But, from a full year perspective, do you believe this inflation / price shock, if I may call it, would lead to more of price growth and volumes to actually start suffering as we get into Q2? Or do you believe, the ticket sizes are small, demand is pretty inelastic, and therefore we see, a healthy volume growth? Is there any guidance you want to give on top line growth for next year? FY23?
Ram, you want to take this?
Yeah. I think, it's a bit hard at this stage to give guidance on volumes. I think, as in general, we are not expecting, because the ticket sizes are small, we are not expecting, demand to drop off. I think, however, when you look at growth, and what we have seen in the last 2 years, right, it is also a function of, how, this COVID and supply side is interrupting the market. If you look at our last 2 years, fundamentally, we've been impacted on summer categories, and, if you see that the categories that we sell around the year, we've been able to recover and our business has gone on. I think bit of pressure has been there on wires, because of, the slowdown in the building sector. So I think, we will also need to look at, these kind of things. So I think, how, the demand for housing is going to go. And, that will to some degree also impact some of the electrical categories. But consumer categories, we are not expecting, because most of the categories that we are into, they are, not high ticket size, and the penetration is still quite low, and the replacement cycles are short. So I think, we should be okay there. Yeah. Similarly, I think, if you look at the electronic segment, for our portfolio, I think that, what has become very clear, we've now, it's like, this is the fourth year. I mean, we had 3 consecutive years where, the summers were bad. The first year, of course, was because of COVID. Yeah, the second year was again COVID. Third year was again COVID. And this year, the things have really picked up from April, right? So I think, so I think, if you're going to be looking at our kind of portfolio, I would say that the consumer part should not get impacted. The electronic part, should fundamentally be also, dependent on how weather will go, and as also some related categories which are very strongly summer-driven, like air coolers and stuff like that. And I think that's what you should watch for. And as far as the electrical is concerned, I think, you should keep an eye on how the construction industry is moving and what is the uptick for housing demand. Yeah.
So on a related, then how's the uptick, if I may ask you? Obviously, you would be fairly well, tuned to the real estate markets. So obviously, we see good numbers from the listed guys, but I guess overall, I'm not too sure whether we're seeing a huge uptrend across the country, or maybe it's just limited to the metros. So in your view, are you seeing that uptake? Are you expecting that to continue, or do you think that may also start slowing down on the housing side of it?
Mithun, you want to take this one?
Yeah, so I think, see, if you look at the electrical business, even with these kind of price increases, there has been, of course, it's not a huge volume growth, there has been a decent volume growth. And if you look at the non-wire business, where the price increases are not so high, that is switchgear and modular switches, there also we are seeing good growth. So I think so far I would say the housing demand is pretty good. For example, we don't sell to builders or, large infrastructure players and stuff like that. Our sale is primarily retail, 95-97% is retail. So I would say that, yes, housing demand has been strong across. Maybe because people are able to borrow money at low interest costs and all that. I think, so the interest cost is something that, if it goes up significantly, it could affect, or people could postpone their decision to build houses and, stuff like that. Because in India, most people are anyway, people take loans to do all these things. So loan interest and EMI is going to be a huge driver for this.
That's right. Secondly, on the margins, as you also rightly pointed out, we are starting to see RM prices correct, or at least flatten out right now, and hopefully going forward come off also. So are you hopeful of maintaining a double-digit margin, EBITDA margin, that is next year? I mean, anything you can comment on that? And specifically on the durables as well, where margins have been a little weak right this year. So, the low single-digit margin there at the EBIT level. So any specific commentary on margin?
So I think as a company, yes, we should be able to maintain, 10% EBITDA, double-digit margins, because I think personally, for V-Guard, I think the worst is over in terms of commodity inflation. I'm hoping. I don't see any more triggers for it to go up, further again. And I think it has reached a level where beyond this, people are not willing to, pay for it. So I think what we will see is probably a decline in commodity prices. Copper has already started to decline. So when this happens, two things will happen. There will be margin expansion in all categories, but there will be a demand contraction in wires, because in wire, copper reduction means, sales price reduction, and which also means retailers will start destocking, and that would have already started. So it is the same scenario what happened, after I think 2014-15, what happened when there was a decline in commodity prices. So we can expect that kind of a scenario. So that's probably what's going to happen.
I think even this year we are not that off from double digit. Having gone through the worst of commodity situation, we're still at 9.5.
Hello, can't hear you. Okay.
Sudarshan was saying that even this year, with the worst of the commodity price inflation, we are only 0.5% off 10% EBITDA margins, which is a pretty good, number in my view.
Understand. And just one last one, if I may, on the fan segment, right? I think you've done very well. The new factory started, the deco fans, I'm assuming, doing very well for us. I'm guessing this is more like a 400 odd crore category for us. By when do you think you could touch 1,000 crores? Any timelines that you want to share?
No, we won't like to give out any projections. Sorry.
Okay, great. All right, great. Thank you so much. All the best.
Thank you.
Thank you. The next question is on the line of Sanjay Avatramani from Envision Capital. Please go ahead.
Yeah, good afternoon and thank you for giving me this opportunity.
Sanjay, your audio is very low. Request you to please speak up a bit.
Yeah. So all my questions have been answered. Just wanted a confirmation that you mentioned that the wire prices which have been hiked in FY22 was in the range of 30 to 35%, right?
Yes, about 35%.
About 35%, correct.
Okay, and excluding wire, I mean all the categories would be increase of 10%.
Correct, 10%.
Okay, okay. And just wanted to know, I mean, the capex which you have guided for 200 crores in the next 3 years. So
yes.
Will this start in FY23 or some of it is already done?
The projects are spread over multiple years. Some projects will get done in FY23, some in 24 and so on.
I think for sake of simplicity, you can, probably pencil in, 70 crore capex per year, more or less. I think that's,
Okay, okay. So 70 crores every year starting FY23, right?
What will happen is these factories won't all start at the same time and, they will all be, starting in with staggered manner. So they probably will get spread out,
Okay, okay, okay. I think that's all from my end. Thank you.
Thank you. The next question is from the line of Aniket Mittal from SBI Mutual Fund. Please go ahead.
Yes, sir. Thank you for the opportunity. Just a few questions on the consumer durable front. So firstly, in terms of our manufacturing facilities that we had opened recently in water heaters and fans, if you could throw some light on that in terms of how are they shaping up in terms of production, utilization from these two factories, and that would be helpful.
So starting with water heaters, which was the first factory we set up, so basically, we were completely dependent on China for imports, 3 years back. And that's 3 to 4 years back. And then we took a call, to, have our own manufacturing for glass coated or vitreous enamel coated tank or VET tanks in India. And since we already had a plant, running, a small plant running in Sikkim, we decided to expand there. And that has been extremely timely because by the time the plant was not even commissioned when COVID hit, in fact, engineers from China and Turkey were in Sikkim commissioning the plant when COVID started. So we got a little bit, hit on that side, but of course in the current year we had full, we were able to extract a good amount of capacity from the plant. If I'm not mistaken, the plant is producing something like at, maybe 70% of its capacity in the last year. And this year probably will touch, something like 85% of its capacity. So that's and the plant primarily produces all types of vitreous coated plant. Apart from this plant, we have also tied up with OEM vendors in India to make the same type of, products, because we didn't want to take a risk with, Sikkim being a remote location. So we wanted to do some risk management. So we also have started some OEMs which will, support for the next few years. So that's as far as the water heater business is concerned, and it's really bounced back, and we have taken back all the shares we have lost. In terms of the fan business, V-Guard was primarily a company that had pretty good presence in the TPW fans, but our presence in ceiling fans was pretty poor. Primarily because we were neither playing in the super economy segment nor playing in the premium segment. So with the current plant, we have now started to play in the mid-segment range, your decorative segment. And we have today launched, we have 3 platforms that have been manufactured in the plant. One platform is, all the 3, 2 of them are doing extremely well. The third one, which is the BLDC fan, is just being launched. So the fan plant in Uttarakhand is also running at close to about 70% capacity, and then probably in the next, next 24 months it will hit 100%.
Okay, that's very helpful. Just to understand on the margin front, right? I mean, if I look at the EBIT margins for the consumer durable segment during this quarter, it's at about 1.7%. Now, obviously, as these plants are ramping up, there has been certain amount of fixed cost absorption that will also come in. And I'm assuming there are certain price hikes that are still pending. So if you could just give some color, that 1.7% number. So what is the impact because of the lack of price hikes that we've taken and because of the fixed cost absorption that's not really come through? So what I mean is if these two entities sort of come into the number, what would be the margins looking like?
Compared to steady state operation, the on-cost from factory about 2% will be there in the current year. And then there are some pricing gaps.
Okay, so 2% plus the price hikes would be like a steady state.
Another 3% pricing gap maybe there.
Yeah. Fair. And just one question actually on the category itself. I understand you do not want to talk about your growth guidance for these, but maybe within both fans and kitchen appliances, if you could talk about what are the type of initiatives that you're taking in terms of expanding your product portfolio and distribution reach, then that would be helpful.
Okay, so I think broadly I will ask Ram to talk a bit about product planning and NPD. That will be better as a company what we've been doing. Ram, you want to touch upon this?
Yeah. So mainly I think, our focus has been on, developing new platforms to fundamentally, increase market accessibility as well as improve the competitiveness of our positions in different segments. So mainly, that is our focus and approach. In fans, I think, we have fundamentally been focusing on BLDC, as well as, the preparation for, the energy efficiency norms that are coming in. And that's fundamentally where we are working on. And I think, we have already launched, as Mithun had said, 2 new platforms, Romanza. And, Romanza was a recent one, which was about 2 months back. And before that was Glado Prime. So I think, these are the platforms, which we expect to drive, particularly Glado, Romanza Art, and, we're talking about the BLDC offerings. I think this is what will drive our growth for the next 12 to 18 months as far as fan is concerned. I think as far as kitchen appliances are concerned, I think fundamentally, there again, we have fundamentally been focusing on, improving our, portfolio presence, in terms of addressing, subcategories and sub-segments in the market, right? And there is a bit of work which is happening in terms of improving our, what I would say, competitiveness. Fundamentally, both the aesthetic side as well as, the efficiency side, right, in terms of cost and margin, so that, we can be more price competitive. So these are the 2 areas where we are fundamentally focusing on. I think mainly our focus is going to be to, improve our, product capability, market addressability, and, the portfolio competitiveness. So that's going to be our fundamental driver, more than, I would say GTM, which is going to be more ongoing in terms of expanding reach and penetration. Yeah.
Fair. Thank you for taking my question. And wish you all the best.
Thank you.
Thank you. A reminder to our participants, please press star and 1 if you wish to ask a question. The next question is from the line of Dhruvesh Shah from JM Financial. Please go ahead.
Hi, sir. Sir, V-Guard has always opted for growth with conservative approach, maintaining healthy cash flow and balance sheet. But after many years, we observed that we have reported negative operating cash flow versus an EBITDA reporting of 338 crores, right? So, as explained by you, this is mainly because of the inventory pile-up or inventory or raw material that we are trying to stock up because of the inflation expectation. But the same is observed since Q4FY2022. It's been 9 months, but we have allowed this matrix to deteriorate for 3 straight quarters. So I would just like to know, is there any change in stance in terms of conservatism, or are we chasing growth at the cost of balance sheet? Thank you.
Okay, so first of all, we are not stocking raw material because we think the price will go up so we can have an arbitrage. We are stocking about raw materials because we got very badly hit and screwed in FY21. In fact, we would have lost nothing less than 250, 300 crores of revenue and maybe 100 crores of gross margin in FY21 because we did not supply. We lost share, we lost space. Retailers were screaming at us. So we said we are not going to be putting ourselves in that place ever again. So that is why we are stocking up raw material, not to make profit because thinking the raw material will go up. So please, there is a huge distinction in between these two strategies. The second thing is to put it in perspective. We got, in a year consumes like 35 to 40 crore of electronics. Today we are stocking almost 40-50 crore of electronics in our warehouse. That means V-Guard is stocking 1 year worth of electronic components. And V-Guard is one of the few companies where we did not have a single day of, single month of sales miss or single month of production miss because of lack of chips. In fact, V-Guard has more stocks than some of the automotive companies in the country. We caught this very early on. So that is just to put it in perspective. Now, about balance sheet, yes, so we would have probably, our inventories are probably higher by about 150 odd crores. I think they will definitely come down. They've already started to come down. You would have seen that sequentially itself some, 35-40 crore of reduction has happened by March. Another 150 crore reduction is expected in the next, 4 to 5 months. So definitely this year we will see, a definite positive cash flow. So the reason is we took a strategic call that I think losing market share and having a lot of cash in the bank does not give us any joy. So we decided that, instead of focusing on cash flows, we'll focus on market share. Cash flows will follow.
And remember, we went to, if I may just add just one point. Actually, our typical finished good inventory which we operate with as a norm is about 45-46 days. And what we have decided is to increase our overall inventory by about 30 days, which was 1 month equivalent, and which I think, RM plus FG together meant that, we were carrying about 300-350 crores of extra inventory, which had converted the cash, which was in our book into inventory. I think, in hindsight, it is possible to understand, how COVID will go. But, sitting where we were sitting at the point in time, when we had got it, for example, in water heater, we had actually degrown by about 20% last year for want of supplies. So as an example, as one category. And there were other categories where, we had challenges, in the peak of COVID as the business started to recover. We couldn't participate in that growth because our inventory norms were far too tighter compared to our competitors. So I think that was some of our competitors. So that was the background and context in which, we made that call. And I think somewhere in the month of November or December, I think it was about October, or November last year, we took the call to get back to normal inventory. However, what happens is that, as we enter the summer months, right, in general, we stock up because many of our, factories are seasonal. And therefore, we need to, start, producing earlier so that we have adequate inventory for the season. So I think that, we could not transmit the, decision that we made to cut inventory to be visible on our, in our inventory numbers. But I think what you will see is between April to July or maybe August, right, you will progressively start seeing our inventory coming back, right? So it's the kind of time it takes to correct because many of our categories are seasonal. So I think, the correction will happen or reflect only after the season is through.
Okay, fair. So can we expect that apart from the coming year's cash flow, we will also recoup the 300-350 crore EBITDA of this year as well completely without impacting the growth and the margins for FY23? Can we expect that? Or how would you look at it? Or the cash flow impact shall continue for a year or two?
So I think you're asking whether the 300 crores of EBITDA will, EBITDA minus depreciation will convert into cash flow plus this year's EBITDA. Is that what you're asking?
Correct.
Yeah. So please also understand that there is CapEx also going on. So Sudarshan, you want to?
Yeah. So one is the working capital impact, I think, which we have explained. There is a reason why stocks are high. At some point, we will bring it back to normal. Then there is CapEx. These investments are being made to get long-term cost competitiveness. And these investments help us to either stop exports or bring in-house what we are sourcing from OEMs. And these these in turn will give us better gross margins. So they will be productive. So that's the reason the investments are being made.
So in terms of that, yes, I think you will see some part of the cash coming back to the earlier levels, but some of it will go into capex as well. But if you add back the capex, yes, ideally we should be back to that earlier level.
Okay, and just the continuation and the last point. So this inventory, while selling it, we won't have to face any major margin or market share problem out there, right?
Yeah, there is one more point. In FY21, you will also see that our debtors were at some 30 days. Now, V-Guard has never had debtors at 30 days. It has always been about 45 to 50 days. So, maybe FY21 is not the right cash position to judge. Maybe you can look at the FY20 cash and then, work from there.
Okay. Yeah, but the inventory that we are planning to put across on table in coming next 6 months, that won't be faced by margin pressure, right? Because we are taking price hikes as well, and we are seeing that competitors are also facing pressure in terms of demand pressure when the prices are hiked and they are losing market share, right? So they have to sell at a lower price, because of which the margins are also...
I'm sorry, I didn't understand the question.
The inventory that we are planning to sell in next 6 months, would there be any margin pressure on the same, given we would want that inventory to be out of our books, or we don't expect any push and there will only be full demand?
Let me just answer that, Mithun. Mithun, let me just answer that. I think our inventory will regularize in normal course, as our planning cycle is based on normative data for, based on sales forecast plus, safety stock, right? So the inventory will progressively come down because, we have only been taking production and we are ordering materials based on the sales forecast. So it will even out. We are not, we have not kept, I think Mithun already explained, we have not kept the inventory to take advantage of input cost. And we will not be managing the inventory with that kind of perspective. So I think as far as input cost increase is concerned, I think that will be transmitted in normal course of business, and that has no bearing on how we are going to set our inventory norm, or how slow or how fast we will move it down. So they are disconnected. I hope I'm clear, right? So
yes.
Yeah.
This was good. Thank you for the time. Thank you.
Basically, as a policy, right? As a company, as a policy, I think our inventory holding is a function of what service level, what SLA we want to meet for our trade partners and for our internal partners, which is our sales force, right? So it's based on the fill rate and the service level that we want to meet to them. And there is some safety stock, and there is some stock, which is produced for meeting the forecast. So that's the basically thing. So we don't do strategic buying. I think the only exception, was what Mithun had talked about in a couple of instances where, for reasons that we fear supply security, we are keeping inventory, not for reasons of, fluctuation in prices. Yeah.
Understood. Thank you very much. Thank you, everyone.
Okay. Yeah.
Thank you. A reminder to our participants, please press star and 1 if you wish to ask a question. The next question is from the line of Hitesh Tang from ICICI Direct. Please go ahead.
Thanks for the opportunity, sir. Sir, most of my questions have been answered. I just wanted to know a few things on the product development front. So we had we had a stake in Gigadyne Energy, and we were planning to launch innovative products in the fast charging battery technology throughout the product categories, be it stabilizer, UPS, also in the consumer durable categories. So where are we in that product launches? And as per your definition, what is the current, premium product contribution in our top line, and what is the contribution is going to be in the next 1 or 2 years through the innovative product launches or say premium product ranges through this kind of technology?
Ram, you want to take this?
Yeah. So I think we had clarified earlier also. Gigadyne is a technology company at this stage in their journey. It's a technology startup, and mainly they are engaged in the what I would say process of technology development and validation. Now they will be developing the technology to be ready for commercialization and give pilot products to us. Now, where we are at this stage, I think, they are in the course of setting a pilot plant, and the machinery for this is supposed to come from China, and I think although the machinery is produced, it is stuck waiting to be shipped out from there. So I think that's where we are now. I think in the meanwhile, they continue with their development activities so that they are able to move their know-how and their capability in terms of developing their battery technology further. I think they, current, and this could again change. It depends on, how things in China shape up. I think by August or September, they hope to commence what I would say is the pilot plant. I think, they will be in a position to supply a sample battery pack to us, which we will be able to test, evaluate, and then decide how we go forward once we are confident that the technology is ready for large-scale commercialization. Now, the second question, which is related to, what is our expectation of contribution of revenue from innovative products? I think, we have not internally, set a target or a goal for how much of revenue should come from innovative products. I think, where the real technology development is involved, it is difficult to define timelines because, they are in what I would say pre-commercialization stage, right? So I think it's a bit difficult to put a number out for, what would be the contribution of such products, right? Because there is uncertainty also associated with technology development products, right? So projects, yeah.
If not the future, sir, what is the current contribution, whatever definition you have of premium product?
So we are not, So we are not presently having a definition where, we are defining what constitutes premium. See, we are a multi-category business, right? Some are more consumer involving, like the consumer durable category. And then there are other categories which are less consumer involving, like a wire or a switch gear, or maybe a, inverter battery. Yeah, these are less consumer engaging. So I think, it's difficult to apply a uniform definition and stretch it across. So we haven't attempted to do that thus far. Yeah.
Okay. Sir, my next question pertains to our market share. You have guided that there is we have gained a market share. We have regained our market share in the water heater category. Sir, is there any other category, top 2, 3, 4 products where we have gained the market share during this quarter, say, year?
So I think, we have had strong growth this year across consumer durable categories, right? And obviously and naturally we would have, gained market share in those categories because if you exclude, air cooler, I think the growth across all these categories should be close to 44, 45%. And so obviously we would have, gained shares in all these categories. For sure we have gained share in fan. For sure we have gained share in water heater this year over last year. But then, in water heater, you may bear in mind, as I think Mission already talked about, the year before, for reasons of, supply chain challenges, we had lost ground. And what we have done is, we have regained that lost ground and probably traveled a bit more, right? So that's as far as water heater is concerned, right? So fan and water heater would be 2 categories. Kitchen also, I think, we are steadily improving our presence and market position in that category. Yeah. But we still remain a very small player at this stage.
Got it, sir. Thank you for the answer, sir. Thank you very much.
Thank you.
Thank you. I now hand the conference over to Mr. Naveen Trivedi from HDFC Securities. Please.
Yeah, just 2 questions before we end the call. Like in the consumer durable business has already reached to more than 1,000 crores sort of a revenue mark, almost doubled in the last 4 to 5 years sort of a time frame. Just wanted to check what is sustainable growth rate for the business, especially when the many subcategories of this segment have reached to healthy scale. And second question is, at this scale, what sort of a EBIT margin is sustainable, considering we have seen EBIT margin ranging from 1.5% to 6% in the last 4-5 years. So once you reach to stable sort of a demand environment and the RM environment, what is sustainable number we can look for? That's all from my side.
No, consumer durable is it's a combination of various categories at various maturity stage. For example, water heater is probably the most important category for us in consumer durables. It is a 25-year-old category for V-Guard. We are one of the largest players in the country. Our EBITDA margins are very high. But we also have a lot of new categories where, we are losing money. So I think it's always going to be difficult because we are always going to launch new products, and some of them may come in consumer durable. So when you talk about consumer durable as a whole segment, it's going to be difficult because we are going to be talking about products with varying maturity and varying EBITDA margins. We believe that in the fan side business, we are still in investment phase. So at least for the next 3 to 4 years, we don't foresee us, making huge EBITDA margins because we want to get to a reasonable size before we, start thinking about EBITDA margins in fans. It doesn't mean that we are losing money in fans. It's just that, our focus today is on ensuring that we are serving all the segments of the market. We are establishing V-Guard as a great, fan, option to consumers, and then we take away share. And there are some new categories like air coolers, kitchen appliances, water purifiers, and where they are very, very tiny in their market share, and they're probably, they're going to be losing money. Water purifiers, we are not losing money because we are selling only on e-commerce, and the cost is less. So I hope I've answered your question. So it's going to be very difficult for us to give you a range, but definitely 1.5% EBITDA margin is not a sustainable EBITDA margin. It's probably one of the worst, so we will only see it going up from here.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference over to Mr. Naveen Trivedi for closing comments. Thank you, and over to you, sir.
Yeah, thank you. Thank you everyone for participating in this call. We also thank the management of V-Guard Industries for giving us the opportunity. Any last comments, Mithun?
No, thank you, Naveen and HDFC for hosting this call. Thank you all for listening in.
Thank you very much. Ladies and gentlemen, on behalf of HDFC Securities, that concludes today's call. Thank you all for joining us, and you may now disconnect your lines. Thank you.
Please subscribe and press the bell icon to never miss another update. Please like, share and comment.